under HERF. You certainly can make you certainly can distribute larger amounts of grants to students. A couple of items that are different than CARES. The first bullet point here that you see, you must prioritize students with exceptional need, and that is listed right in the department's guidance. You are talking to auditors today, so we would highly encourage you to make sure that your methodology, how you are identifying those students with this exceptional need, is well documented. In fact, with HERF Round 2, we had some institutions who had their board or a designated committee approve the methodology, and that approval was documented in the minutes. So again, document, document, document. Under the second bullet here now, we talk about students enrolled exclusively in distance education. They are now eligible to receive HERF Round 2 dollars. That was not the case under the first round of HERF. Now, you're not supposed to condition any of these grants on future enrollment by the student or use them to satisfy outstanding balance. And I would caution you here to be very mindful about how you're structuring transactions. For instance, if you were to take a listing of all students with large balances and give them additional HERF Round 2 dollars or more HERF Round 2 dollars than your other students, hoping that those students would turn around and pay you back the outstanding balances, that may be bringing additional risk to your institution. So you really want to be mindful how you are structuring transactions. And then the final bullet point here talks about the fact that it's Department of Ed's intent for you to distribute any HERF Round 2 dollars to students within 15 days of drawdown, or you may face heightened scrutiny. Now, this is listed right in the Federal Register notice, so be sure to have everything in place before you make that draw to distribute to students. So a couple of words on the institutional share of HERF Round 2. It comes with less stringent guidelines on HERF Round 1. In fact, specific to HERF Round 2, the inclusion of lost revenue is contemplated by the department. Interestingly enough, the Federal Register does not define what lost revenue is and how you calculate it. So this is something that we're staying tuned on. There are various industry groups which have submitted questions to the Department of Education so that we can obtain additional clarification on how to calculate lost revenue. There are specific expenses which are listed as non-eligible for your institutional share, and that was similar under CARES HERF. Such expenses include marketing, recruiting, senior administration bonuses, capital expenditures for athletic facilities or religious worship facilities. Now, you do have the potential to receive a higher institutional shares under HERF 2, and what do I mean by that? Your combined allocation under HERF 2 is most likely going to be higher than HERF 1. You're only required to make student emergency grants equal to your HERF 1 total. So really, you can end up with higher dollars for your institutional share here. Of course, documentation is key. We talked about this. Just make sure that any decisions that you're making are well documented. Joe will talk to us later on about the rules and regulations surrounding the use of federal dollars. They come with pretty high thresholds, so you really want to make sure that you have your thought process well documented. You have your reports. Here's what I used in order to determine my institutional draw. Here's what I used in order to determine my student draw. Make sure everything is well documented. Now, if you're wondering, how much has the department allocated to me under HERF Round 2? There is an actual table that the department published earlier this month, and we have given you the link to that table. We published a pretty helpful FAQ as well as the comparison table that showed some of the major differences between HERF Round 1 and HERF Round 2, and I found that table to be very useful. Now, you may be asking, okay, Grace, well, when it comes to HERF Round 1, we had a significant reporting requirements. There were quarterly reporting requirements. There was an annual reporting requirement. What about HERF Round 2? What type of reporting requirements do we have to comply with this time around? And the reality is that at this point, the Department of Education has not published any guidance on this side, so that's something else that we're keeping an eye on. To be honest, I would be I wouldn't be surprised if there's similar reporting requirements relative to these sets of dollars. Now, finally, we talked a lot about HERF as part of these two stimulus packages. In addition to HERF, there are additional dollars that the very small and smaller institutions can access. There was the Paycheck Protection Program. There are 2 rounds of that. The Employee Retention Credit has changed over time. So certainly something worth looking into if you are a smaller institution relative to additional funding that you may be able to work through. Okay, so we talked at length about 2 of the stimulus funding, which were signed into law in 2020. At this point, we possibly have a 3rd one in the works. It has not been signed into law just yet. It's the American Rescue Plan and comes with a proposed price tag of $1.9 trillion from President Biden. Some of the major provisions of this act, you see them here: additional payment to individuals, extended tax credit, minimum wage increase to $15 an hour, supplemental unemployment insurance benefits, and small business assistance. Under bullet point 3, there is about $350 billion in flexible aid that's being contemplated as part of this package that will go to state and local governments. And I do want to take a second here and talk about this because it's very different than the previous 2 relief packages. We all know that New York State is facing significant deficit, in part due to COVID this year. In fact, for the community college folks on the phone, you saw some of your annual 2020 dollars being held back because of the New York State deficit. So certainly, to the extent New York State is able to access additional funding, that may be direct good news for you, as they are able to make good on their commitments that they have back to you. For the private institutions on the phone today, having New York State be able to close the budget deficit may also mean good news to you, because to the extent that you receive state grants, New York State's ability to fulfill those commitments at previous funding level will be good news to you. And then finally, the American Rescue Plan sets aside or earmarks yet another $35 billion proposed to be allocated to higher education institutions. This is the largest one compared to the 2 previous stimulus packages. It may be limited, however, to public institutions and private institutions serving minority students. So certainly that is something for us to watch and see how it shakes out. Stay tuned on this topic. It's interesting when I think about this American Rescue Plan. In the early days, there seemed to be support on both the Democrat and Republican side behind this bill. In just this past week, some of the effort and energy behind the proposed bill has cooled off, if you will. The 2 areas of big disagreement between the 2 Republican and the Democrat Party seems to be the $15 minimum wage and the income threshold up to which individuals are eligible to receive $1,400. So certainly this is something that we should stay tuned in. When we think about, on one hand, we think about the same political party controlling both the House and the Senate, and in fact, Senator Chuck Schumer just past week talked about the fact that there may be a way for the Democrats to be able to move forward with this plan on their own, but certainly that would mean no lost votes on their end, so that is something to keep a very close eye on. Okay. So let's talk a little bit about the new administration, which has been in place for less than 15 days at this point. There were two big topics that Mr. Biden discussed on the campaign trail related to higher education last year. The first one had to do with student loan relief and forgiveness. The proposal there was that up to $10,000 of student loan per student would be wiped off. Some of the more liberal members of the Democratic Party really wanted to take this a step, or you may say 10 steps further, and talk about completely eliminating existing student debt. At this point, neither of these concepts are part of a current proposed bill, so certainly we are likely to see continued discussion in the future. Now, on the student loan relief side, though, you would note that in January of 2021, so just recently, there were additional steps taken in order to defer those student loan payments through September of 2021. The other big topic discussed as part of the Biden administration's proposal is this concept of college affordability and free tuition. Certainly here in upstate New York, in the state of New York, we have had our own experience with the Excelsius program. We are seeing appetite for this free public education concept on a national level. The proposed plan really called for public higher education to be free, and there was an interesting study that Georgetown University did on that concept, and essentially what they said is if this concept of free public higher education becomes free, what is likely to happen is that the private institutions may see a decline in enrollment over the next decade of 7 to 14%. So certainly a pretty sizable projected enrollment decline. Now that same study, what they noted is that if there is a path towards free higher ed public education, that may drive the overall college demand on a national level, the overall enrollment up to 4 to 8%. Now on the executive order side, we've seen a number of those with the previous administration. So far, the Biden administration has signed some of those into law. And realistically, the purpose of some of the Biden administration executive orders, or more or less to reverse some of the previous administration orders, the ones that received significant media attention are listed here: ending the travel ban from predominantly Muslim countries, repealing changes to the Immigration and Customs Enforcement, halting the construction of the border wall, ending the Remain in Mexico program for individuals seeking asylum, and then calling on Congress to provide paths towards citizenship for DACA individuals. Likely what will happen is those policies are likely to set a more welcoming climate for foreign students. So I wouldn't be surprised if we see a recent resurgence in foreign interest for U.S.-based institutions in the near future, which would be good news for some institutions which have been working on boosting international student enrollment as a way to offset some of their recent enrollment declines. And then finally, Dr. Miguel Cardona was nominated as the Education Secretary in December of 2020. At this point, we are not aware of a date for his confirmation hearing, so that's still to be determined. He is from Connecticut and brings about 20 years of experience in the education sector. Okay, with that, I would launch polling question number 2. The poll is open now. Remember to click submit. And the question is, what do you expect will happen with future COVID-related stimulus funding? Answer A is the rescue plan will pass and will be the final stimulus package. Answer B is it will pass, but there will be more federal help on the way. Answer C is the American Rescue Plan will pass, but will be significantly scaled back. And the last answer here is the President and Congress will be unable to compromise and pass anything of consequence. Apologies, just a second. I want to make sure that we can launch that for you. All right, so hopefully we're back on track with poll number 2. Thank you for your patience. So far it appears that most everyone on the phone is leaning towards answer C. The rescue plan will pass, but be significantly scaled back. So definitely something for us to keep an eye on as we go forward. I'm going to advance the slide. Again, you still have additional time to answer the question, but I'm going to move on to the next one. We have a brief tax update for you. You may remember the Tax Cuts and Jobs Act, or TCJA, back from a few years ago. It brought sweeping changes to unrelated business income activities and how those are taxed. I know many of you on today's call are from tax-exempt institutions, but to the extent that you operate activities which are not in line with your tax-exempt mission, you are subject to tax on the income of those activities. And just to give you an example, what we talk about when we talk about unrelated business activities, for instance, you may be renting space, you may have some unrelated business income from investments. Typically, those are generated through alternative investments. You may have some advertising rights that you're getting paid for. So those are the type of the unrelated business income activities. Now, what the TCJA did is essentially said you can no longer take the loss from one activity and offset it against the gain from a different activity. Essentially what this did is that it requires you now to pay much higher taxes over time because of that concept that you can no longer, you have to silo the unrelated business activities and you can no longer offset the gains with the losses. So if you do have an activity that has a loss and you can no longer offset that loss, what are you to do? Essentially, the TCJA said you can no longer carry back that loss and get a refund right away from previous taxes paid. You have to carry this loss forward, and in fact, even if you do carry it forward to offset future losses, future profits, you cannot offset 100% of those future profits. You still have to pay taxes in the future. So really, a lot of bad news relative to you paying taxes. The one big clarification that happened in 2020 related to the TCJA is there was a question on the table as to how do we silo, how do we set those unrelated business activities in their own silos. And this is really important because the more granular you get, essentially you are paying higher taxes. What the option that was provided in the clarification was that you can use the NAICS codes, but instead of using the 6-digit NAICS codes to identify those different activities, you can just group activities by the first 2 digits of their NAICS codes, which is good news. Again, it allows you for less segregation, if you will. So that was the 2020 update on the TCJA. The CARES Act essentially made some changes that the TCJA brought for us and really scaled them back. So if we think about the CARES Act, you can now carry back some of those net operating losses and get a refund sooner than later as opposed to wait to offset future profits. You also, if you do use current losses to offset future income, you can offset 100% of those incomes as opposed to using 80% that was required under TCJA. So certainly positive changes, and it would result in you paying less taxes. The other big change that the CARES Act brought to us was changes to the charitable contribution, specifically their tax deductibility. And this is really, really critical because if we think about the TCJA, it really increased the standard deduction significantly. And in fact, there was an IRS study from 2018 that said that every 9 of 10 individuals nowadays use a standard deduction. Now, this is bad news from a charitable contribution perspective because individuals no longer get that tax benefit when they make a charitable contribution. The CARES Act essentially did 2 very important things. First, they provided an additional above-the-line deduction for individuals who use the standard deduction. So even though you're using the standard deduction, you can get a benefit when you make that charitable contribution. It also, for those individuals who itemize, it also changed the limitations. So again, good news all around, and something your advancement folks should be mindful of when they're talking to donors, because essentially every dollar that a donor gives you nowadays stretches further because of the CARES Act. Of course, this is only for a portion of time, but certainly good news to share with you donors. And in fact, the December 27, 2020 Act expanding the provisions of the CARES Act so those charitable contribution items are effective for 2021 as well. With that, I would move over and just cover one last slide before turning it over to Joe. We'll talk a little bit about the retirement benefit plans. As institutions, many of you sponsor 403B plans, and this is one of the most complex and highly regulated activities you could do as a plan sponsor. Certainly very highly scrutinized, highly regulated, because of course, participants' retirement dollars are at stake here. The two major changes on the employee benefit plan arena were the Secure Act and the CARES Act. On the Secure Act, you are now required to provide new disclosures for your participants starting at the end of September 2021. And this is important to note here. Essentially, when a participant looks at their account balance, they may see, I have $125,000, that's a large sum of money, but they may not realize that if you take that $125,000 and you translate it into a monthly annuity over the life of the participant, it may equate only to $600 or $700 a month, which arguably is not sufficient dollars to live on. This is what prompted the Department of Labor to require you to provide those additional disclosures to your participants so they truly understand and can see what their dollars accumulate and translate to on a monthly basis. Now, again, this requirement is effective towards the end of September 2021, so you want to be talking to your vendors now as to who will be providing those disclosures for you. There were additional changes that were brought by the Secure Act. One of the biggest ones is changing the age of the required minimum distribution for participants from 70 and a half to 72 to the extent that your plan document was not amended for some of those big changes, make sure that it's amended by the due date that you see here. And then quickly on the CARES Act, there were some serious changes. Essentially, the CARES Act permitted participants, to the extent that they are experiencing negative consequences due to COVID-19, to take large distributions and loans out of their 403B accounts. You had an opportunity as a plan sponsor to go forward with those changes or elect not to. And what we're seeing is that there were some substantial dollars leaving plans to help participants combat the impact of the pandemic. So what you may be thinking about at this point is, are my participants still retirement ready, or do we have to get them back on track after those large distributions that they took from their accounts? Finally, the CARES Act came with a number of other provisions. Again, you have to make sure that your plan document is appropriately amended for any changes that you implemented operationally, and you have the due date listed on this slide. Okay, so I will take a second and just quickly look through the chat section. There are a few individuals who submitted questions here, so thank you for that. One of the questions is, how do we determine exceptional needs students? And that goes back to HERF round 2. And we talked about the fact that the department wants you to really prioritize those exceptional needs students. Certainly, you can be looking at your Pell eligible students, although the department has not put anything in writing specifically requesting you to give more dollars to your Pell eligible students, but that's one way to look at it. And again, you have flexibility because there are no specific guidelines. Make sure your thoughts are thoroughly documented. Okay. I am going to turn it over to Joe, who would get us started by talking about the 2020 Compliance Supplement Addendum.
Okay. Thank you, Grace. So we have a couple more topics to cover here today, starting with the Compliance Supplement Addendum. And for those of you who may not be very familiar with what the Compliance Supplement is, it really is what provides the guidance to us as auditors when we complete the audits of your federal funding, so for the single audit. It comes out every year, and usually there's not a lot of fanfare associated with it. There might be some changes to how we certain procedures that we do over student financial aid, but for the most part, there's not a lot of changes year to year. This year, it is a big deal because the compliance supplement has to cover the HERF funding because those are federal dollars. So the compliance supplement was issued in August, but it did not have any information on how we would audit the HERF funding. There was a promise that they would provide additional guidance by the end of the year, and they really meant it by the end of the year. It was released on December 22nd. So there's not a lot of time provided between then and now to complete the audits of the HERF funding. As such, Department of Ed issued a 3-month extension to any organization that received COVID funding and has a year end through September 30th, 2020. So there's no approval needed. It's an automatic extension. And it's really in response to the fact that they didn't give us a lot of time to get this done. Now, hopefully, in most instances, we won't need an extension to get this done. Many of us did do some of the HERF testing as part of the audit process, just using common sense on what we thought that the Department of Ed would ask us to do. So we do believe that in many cases we should be able to auditors should be able to still meet that filing deadline, the initial one. The HERF funding compliance requirements may not be applicable to all institutions because depending on how much revenue you recognized and when you recognized it, you may be below the threshold needed for testing. So some institutions drew down all of the institutional funding and the student grant funding all within the same fiscal year. In many cases, they will be over the threshold to test. If only a portion of that was done within that fiscal year, it may not fall within 2020. It may be next year. The 2020 compliance supplement only applies to year ends of June 30th, 2020 and later. So what that means is there's really no guidance for May 2020 year ends. Now that doesn't mean that you're exempt from HERF testing. What it means is that we as auditors need to use common sense and apply procedures to May year ends when completing their 2020 audit, single audit. So functionally what we'll do is use the 2020 compliance supplement addendum to apply to the May year ends and document why that's reasonable rather than coming up with something completely from scratch. So what will the auditors be requesting to complete your testing? Logistically, we want to make this an effective and efficient process. So, like I said, depending on each institution and where you were at during the audit process, some of this may already be done as part of your financial statement audit. But what we'll be looking for is the overall methodology and how student grants were determined. And Department of Ed allowed a lot of flexible methodologies here on how each institution was going to do this. In some cases, institutions use an application process where the students would apply for a specific grant amount, and then the institution would award that grant or come up with a dollar amount that was reasonable. In other cases, institutions used a prescribed formula, generally weighted towards those Pell recipients that had received more Pell funding, and that prescribed formula was a mathematical calculation that said how much each student would get. So we'll be looking at the methodology and looking to see how it was applied and that it was reasonable and consistent. We'll also select a sample of students and test how their grant was calculated and how much they received, and was it in compliance with what your institution documented that you would be doing to calculate the funding. In addition to the student portion, there's the institutional portion. And again, Department of Ed gave quite a bit of leeway here on how that would be used. And for private institutions, it's probably a lot easier to document how you're going to use that institutional portion than it may be for community colleges or other public institutions. And the reason being is that room and board refunds are allowed to count as an expense for your institutional portion to satisfy that requirement. So that's really the easiest bucket, and for most institutions that we've talked to, the room and board refunds well exceeded any HERF funding that was received in fiscal 20. That's a little bit different for community colleges based on how they're structured. So in addition to room and board refunds, You can also use expenses that were a direct result of COVID-19. So whether it's purchasing PPE equipment, or installing temperature checks and all that other stuff that all the institutions had to go through, those expenses can be counted as well. And then finally, there's reporting requirements. Copies of the quarterly reporting submitted publicly in October and January, and then also the annual reporting. So these are all things that we'll be looking at as auditors. So we're going to get in the weeds for a second here about the compliance supplement and how it works. This may be more information than many of you want to know, but I think it's valuable for you to understand what we're going to be doing this year because it is different and more than what we've done in the past. So what the compliance supplement does is list applicable compliance requirements that the Department of Education has said that these are applicable to this federal dollars, and then it's up to the auditor to determine if these compliance requirements are direct material. So it's almost like a guide that the Department of Ed gives us, and then it's up to our discretion to determine how much testing and what testing we need to do within that guideline. So let's just talk about each of these briefly. Activities allowed or unallowed. This is a test to determine that the funds were used for the specific purpose identified under the grant. So in this case, for expenses related to the disruption of campus operations due to coronavirus. So we'll be looking for a documented plan to distribute the funds to the students from each institution. We'll be looking to see that the institution placed no restrictions on the expenditure of the funds. So Grace alluded to some of this earlier, but institutions were specifically prohibited from telling students that they had to use the dollars to pay off tuition balances or to pay for the next semester of school. We'll look to see that if the institution did not reimburse itself for costs of the student portion of funding. So again, you were not allowed to take the grants to students and pay the school for amounts owed and call that a grant to the student. If the student chose to pay the institution amounts owed for tuition or other amounts owed, that was fine, but it could not be a condition on it. And then we'll be looking at the institutional portion and really looking at the documentation from each institution as to how you determine what costs were going to be allocated to satisfy the federal requirements. The second compliance requirement is allowable costs. This really works in conjunction with the first one. We'll be looking to see whether expenditures were allowable under the award. So generally, it's tested at the same time as the activities allowed. So if a expense when you're determining your institutional portion, if you look at an expense and you say we're going to apply this to recognize our institutional portion, we would look to see whether that expense truly did meet the definition of that it was needed for response to coronavirus. And then the next two, matching level of effort and earmarking and period of performance, again, they go together. And for the compliance G, it's really just earmarking that we're talking about here. There's no matching or level of effort. So the earmarking is the requirement that 50% of the HERF funding goes to the students as direct student aid. And that's required to be done within 1 year of receiving the funds. So based on the timing of all this, it's entirely possible that institutions may not have fully satisfied that requirement within this fiscal year. It may go into the next fiscal year. And that then ties in with period of performance. So period of performance is when the institution needs to satisfy the requirements of the grant. So if your institution did not spend the student grant dollars either fully or at all within that fiscal year, there may be no period of performance to test within 2020 or earmarking. It may fall into the 2021 fiscal year when the rest of that revenue is recognized. And then procurement is likely not really a big deal for most institutions. If there were sole source purchases used with federal dollars to purchase PPE, then we would look to see whether it was reasonable that you didn't bid out that contract. It may be something that we look at if you apply those PPE expenditures to your HERF institutional portion, but to the extent that you've just applied room and board to satisfy that requirement, we probably don't need to do any more testing there. And then finally, reporting is fairly obvious. Did each institution meet the correct reporting requirements? Now, this last bullet on this slide is pretty important. So we must test both the compliance and the internal control over compliance. What that means is that we can't just test the end result. We also have to test internal controls. This can get a little dicey, especially with the HERF funding, because all this happened very, very quickly. You were awarded the money. You, in many cases, tried to get it out to the students as fast as possible. And so the question is, what controls did you use to ensure that the calculations were correct and that the funds were properly distributed out to students? We know that all the institutions on this line, I'm sure, had a process and controls over that. But the trick will be determining what that control was, what the key control was, and how we're able to test it. All right, so we're going to launch polling question number 3 here. All right, polling question number 3 is open. The question is, which statement is accurate? A, institutions with a May 31st, 2020 year end is exempt from HERF testing. B, HERF funding received in 2021 may be deemed to be a major program if it exceeds $750. C, auditors only need to test HERF compliance and can ignore internal controls over compliance. Or D, auditors don't need to test the institutional portion of HERF grants. There's about 30 seconds left on the poll. The answer, there's still some people who haven't responded, but the answer is B, HERF funding received in 2021 may be deemed to be a major program again if it exceeds $750,000. That $750,000 is the threshold for most institutions on the call today as far as what your major programs would be. For the larger institutions, it may mathematically come out to be a larger number. But for the most part, if you have over $750,000 of federal funding in a specific grant contract, that is considered to be a Type A program, and those programs need to be tested at least once every 3 years. So it is possible that next year, if you had if your HERF grant was tested as major in 2020, it's possible that it would be deemed by your auditors to be to be a low-risk Type A program in 2021 and not tested. We're not really sure on that yet. We'll see how that goes, but just due to all the scrutiny surrounding these HERF grants and what the Department of Education is expecting us to do, I would think it's probably likely that if you exceed the threshold in 2021, it would again be considered to be a Type A program that requires testing. Okay. So on to the last section here, which is discussing some innovation and challenges facing the industry. So we've been talking for a number of years now about declining enrollment that affects not just New York State institutions, but in the future, nationwide. But even before COVID, this was a problem that everyone was dealing with now and expects to get much worse. So the results preliminarily from the census that was conducted in 2020 is that New York State population declined more than any other state in the nation over the past 10 years. So down about 41,000 people over that period of time. And that really accelerated in the last 4 years because New York State is a large immigration state, and with the administration's hostile attitude towards immigration did decline, and that affected New York State proportionally. That's going to result in a loss of at least 1, maybe 2 House seats in Congress, and also will continue to impact the higher education industry, obviously. Nationally, for the past 5 years, undergrad enrollment has fallen by 1.25 million students, or 5%, and it's expected to get worse by the time 2025 or 2026 rolls around. and that's as a result of the birth rate decline from the Great Recession. From 2008 to 2011, birth rates fell dramatically, and they continued to be lower than normal during the economic recovery. So they didn't really ever recover back to pre-Great Recession levels. So as those children grow up and become of college age, there's clearly going to be pressure on institutions from an enrollment standpoint, because many of those students, there won't be as many college-age students as there were before. So there's going to be less supply, more supply and less demand. And then how much worse will this be after COVID? That's the big question that no one really knows. COVID is certainly compounding things, and the question of whether and how we will continue to provide education to students. Will a lot of students continue to want to receive online education versus in-person education? That's a lot of questions that institutions are struggling with right now. So some discussion items that we've had with our clients and with our contacts, both in the industry advocacy section and other institutions that we work with. We've listed some things that we've heard are of importance, and maybe some innovative ideas here. So really the importance of retention is one of those things. And there's a lot of focus on enrollment, and rightly so. It's very important to get students in the door. But then what happens to those students after they enroll? Are they retained? Do they transfer? Do they drop out? Or do they stay with the same institution all the way through graduation? And in many cases, we've heard that there will be a focus on retaining minority and low-income students. So disproportionately, minority and low-income students do not graduate from college. They may start, but in many cases don't finish. So putting forth that initial support system for those students to keep them within your institution and getting them to graduate is going to be worth the effort, because not only is it important from a moral sense to get your students to graduate, but it's just good business sense, because if they stay with your institution all the way through, then they are paying customers. Also, some revenue stream diversification ideas and programs, so increasing graduate programs, and also creating programs that are specifically marketed towards adults who are looking to make a career change, which oftentimes is very successful during tough economic times when people are looking to make a different choice for a career. And then we have a review of current program offerings, and this is often very controversial. Some words that we hear around this are uncomfortable, difficult, impossible to do. This is where you're looking to see individual programs within your institution to see if they're profitable, to see if you should continue providing them or if they should be eliminated. In many cases, where we've seen success in this area is when there is collaboration with faculty, so that there's faculty buy-in from the get-go. In many cases, if there's no faculty buy-in, then there's not a lot of agreement that can be had at the end when the business office presents the findings. So that is difficult to have that discussion up front, but we've seen more success with that. And with economic pain can come opportunity. So I'm sure you've all seen publications over the past few months of institutions who have decided to publicly eliminate programs, and it's not using the pandemic as an excuse, but it is using it as an opportunity to say, hey, we've been in a spiral for many years of declining enrollment and programs that don't have a lot of enrollment within them. Let's take this opportunity to make adjustments, because it's easier to do it now than it is to get buy-in when times are good. Ultimately, this may lead to the elimination of unprofitable majors, or it may lead to the acceptance of loss leaders, so programs that are not profitable, but you're willing to keep them a viable program within your institution because they're critical to mission. So the classic example of that may be a religious school keeping a religious studies program in place because it's critical to mission. Another idea that we've heard is collaboration with local employers, and this is probably more relevant to city schools than to rural schools. But what does your community need? Is there is there a hospital or a nursing home who is looking for nurses, for example, and can your program become a pipeline to employment for your students and for those institutions? And then increasing endowment draws. This is always, again, controversial. In many cases, the president and the board may put pressure on the finance department to increase the endowment draw, and finance may resist those pressures because you all know the ramifications of increasing your draw at a faster rate than what your return is on your endowment, and the risk of eroding the value of your endowment over time. So is it prudent, is it permanent, and is it targeted? And when I say targeted, what I mean is it a special draw for specific reasons? So increased scholarships, increased advertising, increased enrollment initiatives. Those are specific targeted draws as opposed to a general draw increase where it's applied across all your different endowed activities proportionately. So it's two different approaches. The targeted one, in many cases, may seem to be more prudent because you're specifically allocating dollars to those items in need, as opposed to a general draw, which may go to may spend money on areas that don't necessarily need it. We are running low on time here, so I'm just going to skip through to the last poll to make sure that I can get everyone finished on time here. Okay, so the last poll should be open. Okay, I see some responses. So polling question 4, is your institution considering adjusting the endowment draw? A, yes, we have discussed increasing the draw. B, yes, we have discussed increasing the draw for targeted initiatives. C, yes, we have discussed decreasing the draw. Or D, we have not had any discussions yet. Seeing a lot of Ds, so have not had discussions about increasing the draw. And then, actually, there's 4 that have answered C, which is surprising to me that you've discussed decreasing the draw. That would be great. And then 13 respondents have said A or B, which is some form of increasing the draw. There's still 22 people who haven't answered yet, so you still have about 15 seconds. So we're just about out of time here. I'm going to check the chat and see if there's any questions. There's a couple questions. Earlier on our first slide, the annual HERF reporting deadline was listed as a deadline of February 1st. Someone chatted that it's actually extended to February 8th, which I did verify that did happen last Thursday. So the deadline now is February 8th. So our slides were finalized before that happened. So apologies for that, but please make a note if you have them printed or saved that the deadline is actually February 8th. Okay. That ends our presentation. I see another chat that there may be an issue with the polling question, so we'll talk with our support staff on that and find out what happened. But I want to thank you all for attending today. We appreciate your time, and we hope to see you all soon.